Thanks everyone for attending today. Thanks for MarketFest for inviting me to speak. And today I'm going to be talking to you about 5 exit strategies that I feel very strongly will change the way you trade, because I'm going to give you all the complete rules to each and every one of these strategies that are just a piece of the puzzle, but a way in which hopefully you'll be able to apply to your own method and increase your odds for success. Now, I've been teaching for roughly about 15 or 20 years, going on 15 or 20 years now, and there isn't a day I go by where someone doesn't ask me, a potential student of mine or a current member, that says, I'd like to, take advantage more of my exiting method, because sometimes I'll get into a trade and it'll work out fine, and I'll get out just a little bit too quickly, and then the stock, the future, the currency pair, the option, whatever it is, will continue going in my direction. And I'm sitting there thinking, boy, I just gave away the farm. For example, if you look at this picture here in Apple, all right, we're going to be very familiar with this chart because we're going to be applying this to our strategies. Let's say that your strategy, whatever it is, generated a buy signal here. In fact, one of our strategies did generate a buy signal. Okay, the way most traders trade, myself included when I first started trading, you take a nice little profit and then get out after a couple of weeks and say, boy, that was a nice trade. And then you'd exit and watch the stock continue to go higher and higher. This is very frustrating, very discouraging, and one of the worst feelings in the world to know that you left a lot of money on the table. Well, some of the methods I'm going to be sharing with you today would have actually been able to get you out right here, close to the very top of that nice run before Apple actually changed directions. So this promises to be a great presentation. I'd like to welcome you once again. My name is Steven Primo. As Dan said, I am the president and founder of Specialist Trading. I teamed up about 8 years ago with Pro Trader Strategies, and all we do is mentor and teach students around the world in over 110 countries around the world and in virtually every state, all of the tips and techniques I've accumulated in my 40 years of trading, because it's my belief, my philosophy, that the reason why most traders fail, and it's been estimated upwards of 80%, is because you're relying on someone or something else to make your trading decisions for you. Now think of it, look at your own trading. Do you go to a chat room every day to find out how to trade? Do you wait for the news events to come out to find out if it's going to be good or bad news, or what the earnings are, or what the economic news is? Or do you listen to all the pundits on TV and see what they're recommending so that you can find out what to do? This, in my opinion, is a tremendous mistake, and I'm saying this from firsthand experience because this is the way I used to trade myself when I first started trading. And every once in a while it will work, but overall I think there is no consistency in this, because you've basically taken yourself out of the game. And look at the way you trade and make your own decisions. Is it based on what someone or something else is telling you? So over 4 decades, I finally realized that what keeps traders from their success in terms of consistency is not relying on their own decision-making process. And I think it's not their fault, because most of us are not taught the proper education on how to be responsible for our own decisions. But that's what we do at Specialist Trading. We simply provide you with all these things that have shown high levels of consistency: entries, exits, stop placement, full-fledged strategies, different directional techniques and methods, and then mentor you so that you can make your own decisions and you can apply them to your own trading. So that, if you decide to trade aggressively, you can. If you want to trade conservatively, in my opinion, it's a recipe for a disaster when one simply follows what someone else is doing. Okay, you cannot trade like someone else. In fact, it really, in my opinion, no two traders should ever trade alike. You should trade to a style or to an environment that makes you feel comfortable. So that's what we do. We provide you with all these things and mentor you along the way so that you can ultimately feel comfortable. And in my opinion, that's what's going to get you consistent as a trader. As I stated earlier, I've been trading for 40 years. I started my career on the floor of the Pacific Stock Exchange. I was on the floor for 16 years. 9 of those years I was a specialist. A specialist simply made markets. It doesn't mean you're any more special than anyone else. It just simply meant that if you wanted to buy or sell a particular equity like IBM or Waste Management or US Air, you had to go to the trader who specialized, who made a market in that. So I did that for roughly 9 years. I was a specialist during the crash of 1987 and the bull market that followed. So I've been involved in just about every market environment you can think of: straight up, down markets, sideways markets. I've traded just about every strategy, every system, every method you can think of. So in 4 decades, I know what works in terms of consistency, and I know what doesn't. So this is what we do. We're trying to supply our members with this consistency in education so that you can ultimately make your own trading decisions. So that's what we do at Specialist Trading and Pro Trader Strategies. Now, this promises to be a great presentation once again because I'm going to give you 5 specific methods that we usually have only for our members of Specialist Trading. Well, I'll give you all the rules and you can start applying them as soon as today, as soon as I conclude this presentation. But before we begin, as always, we are required first by law to show you this. So please take a moment to view our disclaimer. I'm going to show you a lot of performance results using each and every one of these particular exit techniques, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So once again, we're required to show you this. So as you are taking a brief moment to view our disclaimer, I would also like to invite each and every one of you, if you haven't done so already, to follow us on Twitter. There's our handle right there. You may want to copy that down. Every day I post new different information, anywhere from signals that our strategies have generated to little bits of wisdom along the way that I've accumulated. So lots of great free information, and feel free to follow us on Twitter. Excuse me. Okay, so as I stated earlier, we are strictly an educational company. Even though we provide our members with strategies and signals for these strategies, they are more done so for educational purposes so that you know what to look for. Okay, most of our students start out with the signals and they check their work to see if they're in line with what the signal generated. But then once they fully understand how to identify them and see how they're generated, they no longer have to rely on them anymore, because this is our goal. We want you to rely on your own source, on what you're trading and what you're seeing. Okay, we want you to apply your own entry method, your own exit method, your own stop placement. So as you can see here, my goal is not to force feed you some perfect system or some perfect strategy or some perfect method. My goal is to teach you how to trade with a specialist edge. It's the same edge that turned my trading around some 4 decades ago when I was struggling tremendously, and hopefully it will be able to turn your trading around as well. Okay, so since we are an educational company, I'm going to conduct this webinar as if we were in a classroom. So I want to take each and every one of your questions, but if I stop at every slide for a question, this hour-long class may turn into 5 or 6 hours, so we can't have that much time. So if you kindly wait to the end to ask any questions, I promise I'll get to each and every one of them. But please wait if you happen to join us later. If you have a question, write it down and try to remember it, and I'll get to it at the very end, okay? All right, so let's begin. And we're going to talk about 5 exit strategies, and we're going to be basing them on this one chart, Apple here, because we're not trying to cherry pick the perfect charts where they work perfectly. We're going to only use one chart. And then we'll show you later on how they apply to different time frames in different markets. But while we're explaining the process to you, we'll only stick with this Apple chart, so you're going to become very familiar with it, okay? Now, just let me say here that these exit strategies, if you're long, they're not designed to get you out at the top, okay? And if you're short, they're not designed to cover at the very bottom, okay? I don't know of anything that does that 100% of the time. What we're looking for here are different ways to apply different methods that make you feel comfortable. Some of these will capture larger gains than others, and you just don't know it. But mainly what I want to focus on is that each one has a different energy, a different persona. So it's up to you, once again, to decide which one makes you feel the most comfortable, okay? Some are based off indicators, some are based off calculations, some are based off of patterns. So whatever makes you feel the most comfortable, those are the ones you should stick with, okay? All right, so let's begin. Let's start with our very first exit strategy, and we call this range extension. This is based off range extension. Many people are familiar with this technique, but for those of you who aren't, it's extremely simple. In fact, we use this in a majority of our strategies because it's so simple. All right, so let's look at our Apple chart here, which once again we'll base all of our exit strategies off of. Now, regardless of what strategy you're trading, it makes no difference. I don't care. In this case, we're looking at a daily chart, but I don't care if you trade tick charts, all right, intraday charts. I don't care if you trade weekly or monthly charts. I don't care if you trade range bars. But whatever bar, all the requirements are met for your strategy or technique, okay? Whatever bar that takes place on, we call that the setup bar, okay? That's your setup bar. So as you can see here, where we have the green arrow on the buy signal, that was a setup bar for one of our strategies. That's where all the rules come to play. That's where all the requirements are met. Regardless of what it's based off, it could be based off news, could be based off indicators, It could be based off the tides of the ocean. It absolutely makes no difference. But you need to know what your setup bar is. That's where all the rules come to play, okay? Okay, so we found our setup bar. So what we want to do is measure the range of the setup bar from top to bottom. And when we say top to bottom, we're not talking about open to close on a candlestick. That's not the range. For some reason, traders have come to think that that's the range. That's just the open to close range. The real range is the top of the wick to the bottom of the wick, okay? So when anyone says range, that's really what we're talking about. So you want to measure the extreme high to the extreme low, and whatever amount of points or pips that you're looking at, that will equal to 100%, okay? So you want to take that same amount of points or pips, in this case it's points, and now you simply add it to the very top of that setup or signal bar, and that will give you your 200% exit point. Now, who is this exit point for? Well, this is for traders who like to be in and out quickly. They don't want to be holding positions overnight, or if you're day trading, you like to trade multiple trades and you want to get in and out, okay? Now, this is great. This is the way we usually use this when I was introduced to this method on the floor of the exchange, because we were basically trading for a couple of minutes to 5-10 minutes top. So we wanted to get out very quickly at 200% because it was time to get into the next trade. We were all day trading. But let's say you're a student of risk-reward ratio. And you say, well, Steve, you know, I don't have a very good risk-reward ratio. I'm basically 1-to-1 on this trade. And I've always been told that, you know, if you have a low risk-reward ratio like that, you basically won't make any money or you'll just break even. Well, that may be true depending on how well your strategy is or how well it does or how consistent it is. But let's just say that you want a higher risk-reward ratio. Okay, well, then you wouldn't use that 200% exit level, but you would take the same amount of points from top to bottom and simply add that to the top of the 200, and that would give you your 300% exit level. So that's where you would exit, and you would basically be risking 1 to make 2. Much better, right? A lot of traders feel more comfortable trading this way. They say, okay, now I can live with that. All right, so I'm making 2-to-1. Okay, so I know that for every 1 ratio I risk, I'm willing to make 2. Okay. Still, if you want to make even more, 3-to-1, well, you would take that same amount of points of the 100% range, apply it on top, and that would be your 400% exit range. Okay. Now, this is why we say we do not trade systems, because systems require you to trade the same way each and every time. Okay? You must follow the rules. That's how you come up with stats. That's how you come up with numbers. But trust me, I've traded systems, and each and every one I've traded for the last 4 decades has ultimately blown up. That's where I came to the conclusion that the trader has to be a part of the process. You cannot rely on an outside source simply to tell you what to do. Even though it worked back, I've traded systems that had 10 years of positive numbers that were tremendous numbers. And after maybe 6 months of trading them, they all blew up, okay? So there's no guarantee. That's why we're required to show you that disclaimer in the beginning. There's no guarantee to how back you can look at back testing. It can all change the minute you start trading, and I'm sure some of you have seen that in your experience. So that's why we want to give you information so that you can decide. Once you become a part of the process, once you make your own decisions, that's where you start becoming a consistent trader, okay? So many traders trade this method differently. Some will, like the way I used to, get out exactly at 200 and say, thank you, I'm out, thanks for the trade. Others will get out at 300. Still others will get out at 400, okay? How about this? Others will sell a portion at 200, a portion at 300, and then get out of everything at 400, okay? Or still, others will say, well, when we get up to 200, I'll move my stop wherever it was to unchanged, to where I entered, roughly somewhere around here, okay? And then if we get up to 300, well, then I'll move my stop up to the 200 exit. So I'll let the market take me out. And then if we get up to 400, I'll just keep doing that, or else I'll exit everything at 400. Now, it's been our suggestion over the years that many rallies will end, or sell-offs, if you're going short, will end at the 400% range extension. So I would suggest, especially in the beginning while you're learning this method, to first paper trade, and if you're trying to get as much bang for your buck, exit everything at the 400% exit level, okay? Because as you see here, and what happened in this example, the trend changed, okay? So this is a very simple way to provide an exit level for you. As I stated, we use this in a majority of our techniques at specialist trading, but we let you decide. And then we let you decide how you want to trade it. There is no one right or wrong way to trade it. The wrong way is when you rely on someone else to tell you where to enter, where to exit, where to place your stop. The right way is when you have all the different variables and then you decide for yourself. Okay, so that was range extension. That's exit strategy number 1. Let's move on to exit strategy number 2. This is pivot highs and pivot lows. I'm sure you've all heard of this before. It's very common. It's a great way to stay in a very strong, trendy market. But for those of you who aren't familiar with what pivots are, here is a short-term pivot high. It's basically a 3-bar pattern, okay? Where bar number 1 makes a high, bar number 2 makes a higher high, and bar number 3 makes a lower high. So you kind of have this upside down V or this arrowhead approach here, okay? You will typically see this pattern in downward markets, and you will apply it in down markets. But since we're looking at Apple, which has been going up, well, we're going to be looking at short-term pivot lows, okay? And that's just the opposite side of the coin. It's a 3-bar pattern. Bar number 1 closes low, bar number 2 closes lower, and bar number 3 closes higher. Okay, so now you have this type of a V. You're going to see this pattern as the market goes up, and this is what we're looking for, so we're going to apply this in uptrends. All right, so how can we apply this to our friendly Apple chart here? We're going to take our same standard entry where one of our strategies generate a buy signal. This is our setup bar right here where all the rules and requirements came into play. And then once we're in, we look for that very first 3-bar pivot low, okay? As we can see here, we have 1 bar makes a low, the next bar makes a lower low, and then this bar makes a higher low. So this is our first pivot low. So what you want to do is place your stop just below there. Now, once again, this is not a system. We don't believe in systems. So it's up to you as to where you want to place your stop, the mental stop or whatever you want to do. It can be 1 tick below. A lot of our students like to say, Steve, if it trades 1 tick or 1 pip below, I'm out. A lot of them like to say, well, no, I'll give myself maybe a quarter or half point, okay? It's totally up to you, but you've got to make the decision. But that's where you want to place your stop. All right, so this worked out very nicely. Apple continued to go higher and higher. And now let's look for another one. Well, it looked like it was right here, but in all actuality, here was the next pivot low. You have a low here, a lower low, and it's hard to tell, but this was actually a higher low. So this is the next pivot. Now, depending on where you placed your stop, if it was a tight stop, you would have been stopped out and you would have been exiting on the trade a couple of days later. But if you placed your stop a little bit lower, you would have stayed in the trade and would be able to capture more profits. So this is why we say you must become a part of the process. Now, exit strategy number 1, range extension, would have kept you in much longer. It's based on totally different parameters. This would have kept you in, still with a nice profit, but you would have been out a lot sooner. That's why we say these are entirely different. All right, let's look at exit strategy number 3 now. This is probably our most basic and simplest strategy to use. It's the 9-period exponential average. Okay, so how do we apply this? Well, looking at our Apple chart again, the first thing we're going to want to do once we enter into the trade is simply apply a 9-period exponential. That's it. But the way this works is we're going to wait for the very first close below that. And that's where we're going to place our stop or exit entirely, okay? So as you can see here, once we've entered into the trade, we've gone up and then pulled back a bit, and we touched here. And this is where most students make a mistake. They'll say, well, Steve, I exited right here. Remember, the rule is it must close below the 9-period exponential average. So as you can see, that wasn't your exit point. You're still in the trade. And we continue to track it more. Now we have 3 more bars that traded below the 9-period exponential. Did any one of them close below? Absolutely not. Now the second one looked as if it closed either right on it or a little above, but it never closed below. So you're still in the trade. The only time it closed below was way up here. You've captured a lot of profit in Apple. And so you have 2 choices. You can either exit at the market. Once again, you're part of the process. You have to decide. We're not going to tell you what to do. Or you can place a stop right below. And once again, it all depends up to you. Do you want to place it one tick below? Do you want to place it a full point or two below? It's your call. Had you placed a stop below there, you would have still been in the trade. Had you exited, you would have exited, obviously, the trade, and you probably would have kicked yourself because look what happened. The next week, it went up even higher. But what do we have here? We have the next close below. So the market is telling you, not some guy in a chat room or not some guy on TV, but the market is telling you it may be getting a little tired. We've had two consistent closes below the 9-period exponential. So either you want to exit at the market or place a stop right there. Now, either way, whichever course you would have taken, you would have gone out of the trade, and it was a nice, profitable way to stay in as long as possible. This is probably the simplest method I know of. All you have to do is apply a 9-period exponential. Now, there is one caveat to this, because many times, I'm sure you've seen it yourself whenever you trade, many times, let's say you've gotten into a trade, and the minute you buy, the stock, the future, whatever you're trading, goes straight down. Now, that will happen. It doesn't mean you got stopped out, but it'll go straight down. If you're using this technique, perhaps in the first or second day, it would have closed below the 9-period exponential, and you would have said, well, I'm just exiting. This looks like it was a bad trade. I'm getting out. And then, lo and behold, it bounces straight back up. So our suggestion to this is give this a little room to move, okay? In other words, wait at least 3 to 5 or 6 bars before you start applying this technique. Give yourself a little time for the trade to grow before you start applying it, because you may get stopped out too early based on just some noise that happened within the market, okay? And I'll show you the example of that in just a few moments when we look at other markets and other time frames. All right, so that was exit strategy number 3. Let's go on to exit strategy number 4. Getting a little bit more complicated. We're now looking at the slow stochastic. Now, where this differentiates is now we're going to base our exit points not off a pattern or off a moving average of the actual stock, but off an indicator, what the indicator is doing. That's what's going to be the basis for exit strategy number 4. And we're going to use the standard slow stochastic. This is usually found on any charting software. You know, if you don't have it, ask your tech support, whatever software you're using, or I believe there's some free stock charts online. You can use those. Now, the standard setting for the slow stochastic is set at 14. Don't ask me to go into the inner workings of this particular indicator because I don't personally know. But all I know is that when it's set at 14, basically it's saying the indicator is looking back 14 bars. Whatever bars you're looking at, tick charts, weekly bars, daily bars, it looks back 14 of those to come up with this calculation. Okay? Here's what we're going to do. We're going to edit that. We're going to change that a bit, and we're going down to 5.
Hello, Dan.
So simply go to your tech support, whatever it is, and ask to you know, if you have difficulty in doing this, you're having a default setting of 14, or if you open up your edit box, you should see 14 there. Simply click it on and make it 5. I'm not sure if everyone hears. I hear someone else talking. I'm not sure if that's coming through my or someone else's feedback, but someone may have their mic on, just to let you know. Okay, so you want to change the standard default on the slow stochastic from 14 to 5. Okay, and the reason why we're doing that is because it's going to change the look entirely of the slow stochastic. We're going to be looking for these patterns once again, but before we were looking for a short-term pivot low in the stock, in the actual chart. Now we're looking for these patterns in the indicator. So let me show you what I mean here. Here's our same Apple chart, here's our same buy signal, and here is the 5-period slow stochastic. So you see how we kind of have this kind of jagged approach, up and down jagged approach here, okay? This is what we're looking for, these short-term pivot lows. Now obviously we were short, we were looking for the short-term pivot highs in the stochastic. But what we want to look for are these little V's once again. The same way we were looking for them in the stock, we're looking for a low followed by an upward move. And then once we identify them, we're going to find the 2 correlating bars, the low and then the first upward move, and then apply them to the bars. Whichever of these 2 bars is the lowest, that's where you place your stop, okay? Now, a lot of people say, well, Steve, this is just like a pivot low. What's the difference? Well, I'll show you in the next example where it's not. where you'll actually be placing your stop at a different point because it's based off of the slow stochastic. It's not based off of what the chart is doing at all. Okay, so now you're monitoring the stochastic again, which is this blue line. You're waiting for some type of a V approach. As you monitor it, here we go again. We make a low, and then here's the first move up. Okay, that's the V, the pivot low. So you find the low and the first move up, then find the two correlating bars, all right, which are right here. Whichever of these two bars is the lowest, that's where we're going to place our stop. So that would be below bar number 2. So as you see, it's not the same as a pivot low that's created on the actual bar, because that would have been right here. Remember, we got stopped out. So this technique would have actually kept you in, and your stop, you've moved your stop from here up here. Okay, so you've captured some profit now, and all you do is continue to track the indicator. You watch this blue line, you see it coming lower, you're waiting for the first snap up, and it doesn't matter where this is on the stochastic chart. In this case, it seems as if we're going much lower, but it could be up here. It would not matter. But we track it, and here's the first snap up right here, which creates that V. So we find where the low is created and the first snap up, we find the correlating bars in the actual stock we're trading, and whichever of those two is the lowest, we place our stop just below. All right, you see how this is different from pivot lows? Here was a pivot low, and here was a pivot low. We didn't apply those. It went strictly off of this, the indicator, and here's where our stop is. Okay, and then ultimately you'll continue to track it as high as it goes, or exit and be stopped out. Okay, this is a great tool, once again based off of an indicator, the slow stochastic, and it's edited from a 14-period default down to a 5. So if you missed that, remember, slow stochastic usually has a 14 default setting. We're changing it down to 5. All right, now we move on to our 5th and last exit strategy before we go on to questions, and that's the Dante channels. This is another indicator that you can find on a lot of charting software packages. It's very common. It's used for different things. We're going to use it specifically for exiting, for telling us when the trend has changed. If you do not have the Dante channels, contact your charting software. They should have it available for you, or I know there are a number of free sites, free stock charts on the internet that can provide it for you, okay? Okay, just like the slow stochastic, they have a default setting for the Dante channels. The Dante channel default setting is usually set at 21, okay? This is fine. Once again, we want to edit it. So go into your edit box. If you have the Dante channels, change the default from 21 down to 9. We're going to speed it up just the same way we sped up the slow stochastic, but with a totally different setting. The reason why we want to do this is because we want to capture a short-term trend, and this is going to tell us. So here's our chart of Apple, and now once we apply the Dantes, here's what it should look like. Now the Dantes are not the same as Bollinger Bands or Keltner channels. They're similar to Keltner's, but they're not the same. They're a little bit finely tuned, and what they do is they have this stair-step approach where they go up, sideways, kind of like a stair step, okay? That's what we're looking for. Now, we want all 3 of these to be in sync with each other, okay? We want them all headed in the same stair step upward approach, okay? Even though they may not be doing it at the same time, where you see as this one was going sideways, but this one was heading higher, same as this one, that's okay. They're all headed higher, from a sideways to a higher point. They didn't come from a downward move to an upward move. They're all headed in the same upward direction. As long as they do that, you're in the trade. You're staying long because the trend is telling you we're going higher. So there's no reason to even think about selling until either 1 or 2 of these Dantes are out of sync with the total 3, as we see right here. Now, looking at this, the top one was still going higher. It went a little higher than sideways. That's still going up in an upward movement. But look what happened to the middle and the lower one. They headed lower. So that's your clue to exit this trade. Why? Because the trend is changing and you don't want to be caught giving away a lot of your profits. So once again, you would have exited right here and missed a strong downward move, okay? So this is more of a trend following exit point. It's not an actual level. It's not an actual limit. It's following the trend. Okay, so let's review before we go into questions. Let's review what we gave you today. We gave you the entirety of 5 exit strategies. Once again, these are usually reserved for our members to apply in different strategies, different techniques, different methods. But we gave you all the rules, and you can start applying them as you'd like, okay? You can mix and match. You can use 1 or 2 together. My only suggestion is to first paper trade with them, okay? Because one may feel more comfortable you than the other, or you may not have a certain indicator on your tech support or whatever. So just paper trade first to see which one feels best. Remember, exit number 1 was the range extension. The way you apply that is you measure the range of the setup or signal bar. That's the bar where all the rules are met, where all the requirements are met, everything comes into play, and you're either going to buy or sell based off that last bar. Just simply measure from top of the wick to the bottom of the wick, all right? And whatever amount of points or pips that is, you simply double that. That will give you 200% exit level. You triple it, that will give you the 300%, and quadruple will give you 400. Our only suggestion is, especially in the beginning, exit your position entirely at the 400. We're not a systematic company. We do not keep records, but it's just been over time. Our members have told us, and we've seen it ourselves in our own personal trading, that many times a rally or a sell-off will end at the 400% range extension, okay? So that's a great technique. You can apply it different ways. You can get different levels to exit. You can exit everything at one level. You can use it as a stop placement to move your stop up. It's up to you. Experiment and see if it works for you. We went to pivot highs, pivot lows. Remember, this is simply a 3-bar pattern, very common. If stock is going up, as you see here in Apple, you're looking for pivot lows. That's a low followed by a lower low and a higher low. You have this kind of a V approach. You simply place your stop below wherever you see fit. Right below it, a little bit lower, it's up to you. And then you track it as it goes higher. You'll continue to place your stop below those pivot lows. And you'll let the market take you out. Now, if you're short, you'll do the same thing, but look for pivot highs. Now, remember, you can apply this to anything. A lot of traders will say, well, Steve, I trade options. It doesn't matter. It just means you simply have to track whatever you're trading, all right? If you trade 1 or 2 ticks below that pivot low, then sell your option, okay? Or if you get at the 400% range extension of the stock, sell your option. Remember, you're not trading the option. You're basing your decisions based off what the stock does, okay? We told you about the easiest one, which is just simply a 9-period exponential moving average. All you have to do is apply a 9-period moving average, and the first close below, if you're long, you place a stop, or you can exit at the market. It's your choice. Okay, a lot of traders, especially who like to get in and out quickly, say, first close, I'm out. Okay, I don't care. I just want to get in and out of a trade and look for the next one. That's fine. There's nothing wrong with that. They don't care about risk-reward ratio. They don't care about going for the big bucks. That's their style of trading. That's what is going to make you consistent when you stick with your style of trading, all right? If you're a type of trader that wants to get in and out quickly, but is being forced to hold on profits, to hold on as long as possible, you're not going to feel comfortable. Even if you're making more money, you're not going to be happy with that, and that ultimately you'll implement the rules incorrectly, you won't trade it all the time, and you just won't be profitable. This is why we say no 2 traders should ever trade alike. That's why we provide you with all these different variables. Our only suggestion for the 9-period exponential moving average strategy is to let this grow a little bit. Don't use it on the second bar after you've entered, because many times there's a lot of noise. Everyone's getting in at the same time and then it'll sell off, or everyone's getting out at the same time and they'll rally. So give it a little room to grow, 5 to 6, 7 bars before you start applying the 9-period exponential. And then we go to slow stochastic, where we're starting to use indicators now to tell us where to place our stops instead of a pattern or instead of the actual stop. Remember, the slow stochastic is a very common indicator found just about in every charting software. It's usually defaulted at 14, meaning that when you open up the edit box, you'll see that there's a 14 there. The length can say 14, or the default will say 14. All you want to do is click that on and change it to read 5. This will make the stochastic more choppy, and that's what we're looking for. We're looking for that pivot in the 5-period stochastic pattern of the indicator. You find the correlating bars where that pivot was created on the indicator in the stock or whatever you're trading, and place your stop just below the lowest of those 2 bars, okay? Excuse me. And then our last exit strategy was based off the Donjian channels. That's a very common indicator as well. If you don't have it, ask your charting software, or you can look or do a Google search online. I know that Free Stock Charts, who we're not affiliated with at all, has it as well. But that is usually defaulted at a 21 setting. What you want to do is change that, edit that to read 9, and at 9 o'clock you will be able to, at 9 you will be able to see if the trend changes, okay? Once the trend has changed, meaning that all 3 of those channels are out of sync, you want to get out of the trade entirely, okay? Okay, so let me show you just a couple of other markets, because I don't want you to think that this can only apply to stock and on daily bars. Let's look at a 5-minute chart of the E-mini futures. Now, once again, this was an actual signal generated by one of our strategies to go short on a 5-minute time frame, okay? Now, that's the signal bar, as you see right here. Regardless of what method you trade, regardless of what it's based off of, it makes no difference. When all the rules come into play, that is your signal bar. Now, if we're using the range extension, we want to measure the range of that. Doesn't matter if we're looking at a 5-minute bar. We still measure the range, and then we simply subtract since we're short. This automatically gives us our 200 level, our 300, and our 400. Now, don't worry. If you're an intraday or day trader, after a little practice, this does not take a lot of time at all. In fact, I think there are some tools such as Fibonacci indicators that will apply this for you automatically, and you can see where these levels are. So if you had gone short somewhere around here, you could decide to get in and out of the trade right here, place a limit order, you get out here or here. It's up to you. Or you could get out part, if you're trading multiple contracts, cover part here, and part here. Or let's say you have your stop up here. Once we get to the 200% range, you move your stop to unchanged. Once we get to 300, you move your stop to 200. And once we get to 400, we always suggest to exit. Even though we're looking at a 5-minute chart, we have found that over time, if you have a profit at 400, such as we have right here, oftentimes the trend changes, as we did right here. So it's better simply in the beginning to exit everything at the 400% range extension and move on to the next setup. Or how about Forex, okay? An entirely different market and an entirely different time frame. This is a weekly chart of the Canadian dollar. Here was another buy set up by one of our strategies to go long on a weekly chart. Here's our setup bar. In this instance, we are going to be trading with the 9-period exponential. Now remember, these strategies for exiting are not designed to get you out of the top. A lot of people would say, well, Steve, boy, here's the first close. How come I wanted to get out here? Well, then you may want to use a different technique, okay? But in this particular strategy, it's just designed to capture profits. Now, someone looking at this would say, well, boy, why didn't I get out up here? But if you had exited right here or stopped just below, it still would have been a great trade, because look what happened, okay? You would have ultimately given everything back if you held on and hoped and prayed for the Canadian dollar to go back up, the way so many other traders do. So this is why we say they're not designed to get you out of the top or out of the bottom if you're short. They're simply designed in different ways to capture profits. It's up to you to decide. You're in charge. You can't blame anybody, because you're going to be deciding which one you want to use. And then when you have a tremendous profit, you don't have to thank or pay some signal service. You can pat yourself on the back because you did it, okay? You're responsible for your own trading decisions. Now, as I stated earlier, the one thing we really want to stress when you're using the 9-period exponential is to give this a little room to grow, because look at this. If you had entered right here where this bar closed, look what happened on the very next week. We closed below there. So if you had used this rule, just using the standard benchmark, you would have said, well, I went to this guy's webinar, and Steve Primo said to exit on the first close below the 9-period exponential. So I guess I got out and it went straight up. No, we didn't say that. We said give this a little room to grow, anywhere from 3 to 6 bars. And if you had given that room, you would have been able to capture all of this profit in the coming months. So that's why, you know, don't simply wait for this, you know, for the next 2 or 3 bars to get out. Okay, so there you have it. 5 exit strategies that I strongly feel will change the way you trade. And why? Because you're putting the power back in your hands. Remember, it's our philosophy that the reason why most traders fail is because basically you're taking yourself out of the game. You're going to a chat room or a trade room, or you're relying on some guy on TV or some indicator or some news event to tell you what to do. What we do at Specialist Trading and Pro Trader Strategies is provide you with the education, all the things that I've accumulated in my 4 decades of trading, so that you can ultimately make your own trading decisions. I have worked with hundreds, if not thousands, of traders over the years, okay? And the ones that have failed, the ones that are no longer trading, are the ones that took themselves out of the game, that relied on some news event or some great indicator to tell them when to buy and when to sell. But the ones who have still traded 10, 20, 30 years down the road are the ones that make their own trading decisions, are the ones that don't rely on some master system or some trading guru, the ones that rely on their own trading education. So this is what we provide you with, education, so that you can be in charge of your own trading destiny. Okay, so as we close here, before you ask me questions, I want to ask you a question, and I want you to answer yourself honestly. Do you think these exits, any one of them, could have helped your trading this past year? I mean, go back and look at your last 10, 20 trades. Could they have helped if you applied just one of them to your trading? What if I could give you maybe 3, 4, maybe 5 more trading techniques just like this, but similar, but entirely different, not the same at all? And what if I could give you a full-fledged strategy? Because all I did today was give you one piece of the puzzle. I gave you the exit point. But what if I could give you the entries, stop placement, exit points, as well as money management? Well, here's what we're offering all the attendees today at MarketFest. This is our special discount for all of the attendees today. It's our Secrets of a Stock Exchange Specialist training session. Now, some years ago, I was asked to be the head speaker at a conference in Colorado, where I spoke in front of hundreds of people for roughly about 3 hours. And I talked about many more high probability trading edges, different from what I just shared with you today. I talked about which indicators to use, but most especially which ones not to use. I talked about the difference between a system versus a strategy. I told all the people in attendance what's the #1 chart pattern you should be looking for and be applying to any method you trade. But I think the best thing about this 3-hour conference I spoke at is I gave all the rules, entries, exits, stop placements to one of our best pullback strategies. And that's strategy #1, okay? Now, they recorded this entirely. So now we have this as a video seminar, 3 hours of the entire conference that I spoke at, my portion of speaking, that is entirely recorded, and we have a full-fledged strategy. In fact, let me share with you a couple of examples of how strategy #1 works. It works in any market, any time frame. Once again, let me show you just a few examples here in Halliburton. Now, someone looking at this chart would say, well, Steve, this is definitely a chart you shouldn't be fooling with, a stock you shouldn't be fooling with. Obviously, it had some type of exhaustion gap, and then it's gone straight down. The chat room I go to doesn't like this. The trading room doesn't like this. The guru I follow says this should be shorted. And all the institutional stuff I track has heavy volume of the institution selling this. So this is something I should be selling, right? In fact, it broke its major support. Did you notice how everything I said, all those justifications were all based off outside sources? Remember, this is why most traders fail. This is what they listen to, myself included. I'm not trying to be arrogant or condescending. This is the way I used to trade when I first started trading, and it didn't make me a dime. I would have maybe a couple of good trades, but then I'd give everything back. So what is the market telling us? Well, strategy #1 listens to the market. And what strategy #1 deemed is that this stock is actually in an overall uptrend. And what you're seeing right here, the sell-off, is just a pullback in an overall uptrend. Therefore, it generated a buy signal where everyone else was selling. And as you can see in the next month or so, the stock went all the way back up to new highs while everyone else was selling. Okay? Same thing can work to the downside. If you see this example here in PBI, someone looking at this could say, well, Steve, boy, this has some major support right here at these levels, kind of has a double bottom. There's great Elliott wave support. The guy I follow, that my guru says you got to buy this, and I'm going to just jump in and buy at the market. All right? Well, once again, all based on what someone or something is telling you. What is the market telling you? The market's telling you that this stock was in an overall downtrend and that this little bounce right here was just a pullback. And strategy number one, rightfully so, generated a sell signal. Look what happened the next day. What happened to all the major support? What happened to all the institutions? What happened to everything? Okay? Obviously, some news came out. Well, it wasn't as if someone at PBI called us up the night before and said, hi, this is the CEO. We're going to be shorting everything because we have some terrible news coming out the next day. Can you tell all of your students to go short this? No one let us know. The only thing we listened to was the market itself. And that's what strategy number one does. It's our most consistent pullback method. And guess what? I'm going to supply it with all the rules, entries, exits, stop placement, as well as money management, including 3 hours of training of things that I've accumulated in my 4 decades of trading, from starting on the floor to trading on my own personal account, okay? Now, my sister site, which is Pro Trader Strategies, they handle all the marketing of my courses and all the discounts. They have this advertised on their site for close to $1,000. There's that much information jam-packed in there. But we're offering this today for all the attendees at MarketFest for only $37, but that's for an extremely limited time. I believe only for the next 24 hours. This is not something that's going to, you have to wait to be sent the video or the disc. It's not something that will disintegrate in 2 or 3 weeks. We're going to send you the link to this video, and it's yours for life, okay? You can watch it on your lunch break. You can watch it during market hours. You can use it as a refresher course. But the best thing about this is that it's discounted drastically for $37 down. I mean, I think that many of you probably spent more than $37 alone in commission costs probably yesterday just trading, okay? You can't go out to dinner for less than $100 these days with someone else. So $37 is a great, great, great discount to be supplied with 40 years of market education. So here's how to take advantage of this special offer. You can contact my sister site, Pro Trader Strategies. You can email them, or probably the best thing to do would be to call them either directly at 310-598-6677, or if you see the link at the very bottom of this, you can just simply copy and paste that link. It's not a live link. I believe they may be posting that live link later on, but that's the link that you would go to. It's a link that will take you up to the $37 sign up, okay? So once again, this is great, great information. It's taken me 40 years to accumulate all this in a 3-hour video session, plus a full-fledged strategy. One thing I didn't mention about this as well is that you're also going to get 40 years of mentoring. In other words, you'll get my private email address. You can contact me whenever you'd like with any questions. And it doesn't mean this only lasts for a couple of weeks. I've been trading for 40 years. I see no signs of stopping now. So whenever you'd like to email me, you can email me with any questions regarding anything in the video or anything you think about the markets or trading. So this is a great deal. I see that they posted the live link. Once again, the link at the very bottom is where you go to, but at the bottom of the screen, it's not live. You'd have to copy and paste that. But in the right-hand corner of your GoToWebinar column there in the chat box, they've posted the live link, and you just simply click that on, and you'll get the $37 offer. But remember, I believe in 24 offers, that goes back to close to 1,000. So now's the time to take advantage of that, and then have me as your personal mentor for the next 24 hours. I'll be there available in terms of at that special rate, okay? I'm gonna leave all this information up here and open up the question and answer box. Thanks for waiting. Let me just see what they have here. It says, can you use the 9-period exponential on intraday? Yes. Any of these strategies, once again, that I just shared with you can be applied to any market, any time frame, and in any direction. I showed a 5-minute chart of the E-mini. I also showed a weekly chart of the currency pairs. So it does not make any difference. And remember, once again, experiment with them. You didn't have to pay for any of this. Go ahead and experiment. See if it works for you. Someone could be applying it to their charts and say, well, I've applied this certain exit strategy. It doesn't work well for me, but the other one does. Where someone else could say, boy, the one you don't like works perfectly for me. And the one you like doesn't work well for my style of trading. It makes no difference, okay? What is the right answer is what works for you. So we're giving you 5 variables for exits. Pick the one or ones that make you feel the most comfortable and then learn them like the back of your hand. So please, my only suggestion is to paper trade first. So many students, their eyes light up when they see these and they jump into the market and they lose money. And then they say, this stuff doesn't work. This guy is a phony. He doesn't teach the right. And then when I asked them, I said, well, show me your examples. And they inevitably executed them incorrectly because they didn't take the time to study and learn the rules. So learn the rules and you'll really get some nice consistency with this, okay? Thank you, Dan. Good education and no sales pitch. No, Dan, this is, once again, our philosophy. We're trying to educate you. And we're a little bit different from other educators or other presenters in that, you know, we want to leave you with something. If you decide not to come along and be a student of ours, that's okay. We still want to leave you some information so that you can start using. So we don't just talk about for the next hour some master system and then you have to pay tons of money in order to find out how it works. We're going to give you something for a very low price. And then we really think you can see in our sincerity of teaching you for something for free throughout the webinar that you'll come back and want to be a student of ours. See, Mark says, on the range extension, 100%, et cetera, is this for options, as it's pretty unlikely that any stocks are going to go up that much? No, it happens with stocks all the time. I mean, you can use this. We have our members apply this for stocks all the time. Okay, if you look at Amazon, well, we had some really nice buy signals in some of our strategies at the bottom of that nice run. Okay, you could have applied a 400% exit range on that tremendously. Same thing with Netflix. Okay. Same thing with Tesla, if you're looking at longer term charts. So there's a lot of great, sure, you can apply this. Makes no difference. But remember, it's up to you. You're the one who decides. If you do the back testing and research and you say, well, it doesn't work well for me, great, that's your answer. But you can't just say that without doing, you know, you have to be part of the process. That's our philosophy. We want to make you a part of the process. This is not a system. There's work applied on your part. That's how you become a trader. That's how you become a consistent trader, okay? Let's see here. On the slow stochastics, the 5 period for the D and K period, I'm not really sure. I know the default is, whatever the 14 is, that you change that to read 5, okay? So whatever is set at 14, that should be changed to read 5. Remember I told you, I really don't look at the indicators. But on my charting software, it says 14. I just simply changed it to read 5, okay? Bob asked, did you show an example of an exit using Dante channels? Yes, I did. It was one of the last ones. It was strategy number 5, the exit number 5. But remember, the Dante channels really uses no exact exit level or pinpoint. It's mainly a trend following exit strategy. So when 1 or 2 of those Dante channels are out of sync with the others, that's your exit signal to get out. Okay, you can get out at the market, you can put a stop somewhere, but that's just a red flag telling you you should be out now. Okay, so that's the way the Dantians work. Let's see, on the ATR length from 20 to 9, what about a length keep at 40? Oh, on the Dantian average shoe length from 20 to 9, what about the entry length? I'm not sure what you mean by entry length. I don't have that, Mark, on my Dantian channels. I just have the standard default is 21 on the Dantian, or 20. I've seen some charting software, the Dantian standard default is 20. Either 20 or 21, but you want to change it to read 9. Now, once again, these are not systems. We want you to experiment and do the research. Some of our students say, Steve, I love these are great, but you know what? I found that an 8-period exponential works better than a 9-period. Or I found that a 12-period Dantian works better than a 9. That's fine. These are not systems. They're not, you know, magic indicators that are telling you if that works for you, fine. Okay, but just use them according to the same format, the same rules, okay? Earl asks, when was the tape done and how does it look? Well, it's not a tape, once again, Earl. This is a link we send you of the video. It's high quality, and for $37, you know, I don't think you can get something better than that. I wouldn't be complaining about $37. It's not. It was done roughly about 5 years ago in Colorado. So we have many. If you go on the Pro Trader Strategies or on my website, Specialist Trading, you'll see a lot of testimonials. but I don't think you should be quibbling over a $37 deal, because that will go up to close to $1,000 if you're worried about the quality of that, okay? Mark says, my platform is think or swim, so there are more variables. Well, Mark, you know what I would do? I would contact Pro Trader Strategies because we have our own charting platform. I'm not going to go into that right now, but you could talk to them. I know they have very many specials where all these charts are already pre-canned and they're already in. And so you could talk to them. Maybe they may be able to set you up with something, okay? Let's see, Michael says, I missed the webinar entirely. Sorry, Michael. It says, but will offer be available after seeing the replay? You know what? That would probably be something you'd have to contact Pro Trader Strategies, because they handle all of that. So email them. But remember, $37. You can't fill up your gas tank for less than $50 sometimes these days. So you know, $37. This is yours for life. We have people that, you know, once they've gotten this, they said, this is the best information I've got, educational information in my life for such a small price. I can't believe it that you're giving this stuff away, plus a strategy. I mean, I can't imagine you buying one of our best pullback strategies for less than $500. Well, you're getting it included for $37. So once again, as I stated earlier, I wouldn't be quibbling about this because the actual price is close to $1,000. I would take advantage of it. You know, maybe cut out the coffee for a week, and if $37 is hard to come by, and you'll be able to afford this. Okay. Okay, I think we're just about out of time. I want to thank you all for attending. I hope you got something out of this. As I stated earlier, we are an educational company, and the reason being is because we feel that's what's missing in most traders' mindset. Most traders, myself included, when you first started trading, are told to listen to some guru or some master indicator or wait for the earnings, and then that will tell you what to do. Well, if that's supposed to work, then why is it estimated upwards of 80% of all traders fail? So obviously there's no consistency in that. Maybe 20% of all traders are able to follow that, but myself included, I couldn't make a dime when I tried to listen to someone or a master system. It didn't work. I was lucky enough to have some mentors on the floor of the stock exchange. These were specialists themselves who turned my trading around, and they gave me the same concepts and beliefs that I share with all of my students, and that is the only way you will become consistent is if you make your own trading decisions. So they gave me all the same information that I teach to all of my students, and I really feel this information and this way of trading has been the core of what's been able to sustain me for 40 years. That's why I'm still here. I haven't relied on an outside source for going on 40 years now. I make my own decisions based off techniques and sound fundamental tips that have worked over the ages of time, okay? Sure, you have small losses from time to time. That's perfectly normal, but it's about being consistent, okay? 2 steps forward, 1 step back. I used to be on the floor with over 200 traders, and many of them made tons of money in a relatively short time, hundreds of thousands, if not millions of dollars in a matter of days. And guess what? Each and every one of them gave it all back. So what good is some master method or system that makes tons of money and then gives it all back because of the risk? It's much better to have a 2-step forward, 1 step back, consistent approach, and that's what we try and instill in all of our students, okay? So come on board with a great introductory offer of $37. There's great information. And, you know, as I stated, you will have my email address as your personal mentor, okay? So lots of great ways in which to contact us, okay? If there's no further questions, I guess that's about it for me. Do you have a screen showing everything? I don't understand what you mean by a screen showing everything, Michael. Thank you, Rob. Rob just ordered it, and so did Michael, I believe, an offer. Oh, yes, well, I showed it earlier, Michael. I'll just go back once again. Here's what we have. Here's the offer, and there is the price. And I can't show all of the different because, you know, 3 hours I spoke. There's just tons of things offered in it, okay? But I spoke about a lot more, and plus, as I stated, I give you all the rules, the entries, the exits, and the stop placement, okay? And also, you're going to have my email address where you can email me whenever you'd like. So it's a great offer that usually runs close to $1,037, okay? So take advantage of this. You owe yourself a favor to be here and take advantage of it, okay? Okay, I want to say thank you once again to everyone. This is the information. Thank you so much. I hope you got something out of this. If you're just going to experiment with what we gave you today and don't want to become a student of mine, I totally understand, but please paper trade those methods first, okay? before you jump in. Thanks, Dan, for inviting me. Thanks to everyone at MarketFest. And I'll hand it back to you if there are no more questions. Bye-bye.